Alright guys, this is the best and easiest scalping strategy you will ever see on YouTube. Now regardless of your ability, you're going to learn how to turn a huge profit in just 10 trades using an entirely mechanical approach. Now in a second, you're going to see how in just a couple of days you could have increased your account by upwards of 30%. And at the end of the video, I'm going to reveal a method where you could possibly increase it and realistically do that too. Now first of all, you need to understand boss and chalk for directional bias and order blocks. So if you're unfamiliar, I will link a couple of videos in my description below. Let's get stuck in with the rules just by using the chart as an example. Okay, so rule number one is that we trade zone to zone using the M15 and we use directional boss and chop for our bias. What that means is when we've got boss, that means that we're trying to charge in the way of boss. We only want to be taking trades in a pro trend direction. So we're always targeting boss. Boss has about a 70% chance of being hit before chalk. So we do not want to be going in the opposite direction of the market. Prime example as just here. This is an internal structure, just so you're aware, internal break right here. We're waiting on a pullback with this trade and we are literally just feeding it straight to the next zone. We are refilling that imbalance, okay? So a key part to order blocks. The directional bias is there as well, internally at the very least. Next up, we are taking trades only on the M1 and we are looking for reversal candles. You don't need to wait for chalk to occur. You can do it just based purely on price action. Okay, so over here, showing the M1, and on this trade right here, yes, you've had a couple of chances to get into it. Both of them had failed, but you get involved on the reversal candle. So where the market is showing that it's looking to turn around. The next bit is that there's going to be two take profits, okay? The first take profit is going to be on the nearest swing on the M1, where you're going to take off 50% of your position. And then the next take profit is the next M15, okay? So again, refilling that imbalance. Don't worry, in my results, which I'm going to show you at the end, I do factor in that adjustment for the 50% take profit. And again, I will reveal how you can improve on that even further. And another key rule for using this entry technique is that it is market orders only, okay? We do not use pending orders. So when the candle closes, you get in. And then finally, if price was to just shoot directly through an area without giving you that reversal candle, you just don't take the trade. Now let's look at my results and then we'll go through and find them on the chart. So just to make a little bit of sense of this spreadsheet, I'm just going to go along the tabs on the top. We've got the date entered, so you can go back and check, and the time entered that you've got into the trade, and the time exit, so you can monitor how long you've actually been in the position for, the entry, the stop loss in pips, the take one in pips, the take two in pips, whether or not stop loss was hit, TP1 was hit, TP2 was hit, and the adjusted growth. Now, I'm just gonna say something about the stop loss, okay? So I know also a lot of people will say those stop losses are too tight. They are not. We are entering on market orders, okay? This stop loss would be too tight if you're entering on a pending order because your stop loss is visible. Okay, but for us, our stop loss is not visible because we're getting into the market first, then placing the stop loss. Okay, with that, the adjusted growth, this is the formula to use. F2 divided by E2 divided by 2. So F2, which is TP1 pips, divided by the stop loss, and then divide that by 2, which is going to be your first 50%. And then it's going to be G2 divided by E2, which is the stop loss again. So TP2 and the stop loss, and then divide that by 2 because it's got a value of 50% of the original size of the trade. And then you get the adjusted growth. So with all of these trades, just before we get stuck into them, I hit the stop loss 3 times out of 10. All right, which means that we've taken profit on at least 7 of those trades of at least 50% of that position, and TP2 4 times out of 10, which is phenomenal. In case you're not sure, or if you're not confident to be able to hold your trades to TP2, here is a reason why you probably should. These two columns here, L and M, do not have the adjusted values, okay? They are not taking profit of 50% on each of these. They are taking the full profit. So what we have is the totals down the bottom. If you use the adjusted formula where it's going to be taking 50% at each of these positions to protect your account, you're going to get 27.5%. If you take full profit at TP1, you're going to get 20.5. And if you take all at TP2, you're going to get 31, close to 31.5. Now just factor in, because the size of the positions that you're going to be in, that there's going to be about a 1.6 R for a stop loss because of your commissions. Okay, so for every loss, really you should be factoring in 1.6 as a minus, and then for every win as well, also factor in 0.6 as a deduction, but it really doesn't make too much of a difference. Also, the beauty of adding the entry and exit time is quite important for trying to factor in the times that you are available for the chart. Okay, so my typical trading time is a little bit extreme. It's about 5:30 in the morning to about 8 o'clock at night. And that means that I would have missed 4 of these 10 trades and got into only 6. Now, if I'd have got into only those 6 trades, I would have hit my stop loss once, and I would have hit TP1 5 of 6 times and TP2 3 of 6 times. And those adjusted totals are 21.5, let's call it, 16.5 for TP1 and 25% for TP2. So in my eyes, the logical thing to do is just target full profit on TP2. However, the psychology of going through drawdowns on human errors is more painful than just taking a smaller amount. So really, I would recommend to anybody to split your positions. Don't worry, at the end, I'm going to show you how you can improve this even further. Now, if you're still not sure on the stop loss on having your spread so small, use the broker that's in my link below. You do not have spreads. It's a raw ECN account. At the end of the video, I'm going to reveal how you can improve the strategy even further and probably double these figures. Now we've done that, let's go through each of our trades. Now trade number 1 is quite a decent one to get started on because it's just a little bit strange, and you'll get this every now and then. Even though it's not an engulfing candle, it is a bullish candle, and it did not break lower than the previous one. It's also mitigated the previous area, or the bigger POI, the M15, by more than 50%. But the M1 is actually bringing us out over there, or at the very least over here. So our actual take profit, our initial take profit, is going to be pretty much the structure of the M15. For our TP1 and TP2, we're just going to default to right here, and the end result ended up in a win. Now for trade number 2 to make sense, we need to observe the M15 direction. If the M15 boss is all the way up here, right there, we're expecting for the market to go long. So what we've done is we've gone back, we've looked at the nearest order block, which makes sense to try and get a reversal from, look for an M1 trade, which we'll look at in a second, and feed it up to the previous unmitigated M15. For the market to be able to continue in the same direction, it needs to break above here, but first of all, it's got to mitigate this kind of area first. So in this situation, all what had happened is that we'd got in on a reversal candle, which was right here. We had a sweep as well, a very bullish candle, a stop loss of 1.7. Our TP1 was very nearby. It was only like a 2R trade. And then TP2 was right there. So it was only going to be a small risk reward ratio of 4.29 total. But in this scenario, it just didn't work out. It wicked us just after getting involved about 10 minutes later. Now for trades 3, 4, and 5, we had to wait for a directional bias change. So we ended up getting chock with a body. So technically speaking, we had chock right there. So chock continues its way down until we actually get a body break. So we then have the confirmation that the market's changed. This was not lower than this. So this was an equal low. This is not the order block which we want to be taking trades from. It is this one. And then as a backup, it's this one at the very top. So looking on the M1, we had, trades 3, 4, and 5 all happen very, very quick in quick succession. And it was all around about midnight, so it's the Asian session. It is my favorite session to trade, but I'm not doing it so often anymore because of life schedules. The first trade was not off the first reversal candle, it was off the second one. That second blue candle has broken lower than the last white candle. So I would have entered off of there, put my stop loss behind. Effectively, it should have been that last candle, but stop loss would have gone there. TP1 behind the nearest viable swing on the M1, and then the M15 being the target, looking for an 8R in total. Trade number 4 was looking at pretty much the same again. So we had a nice push up with a white candle, and then we had a blue candle pressing down, nothing in it. then a white candle, then a strong blue candle. For me, when I was looking at this on bar replay, effectively we hadn't had the break below, so this was a premature entry. This would have been seen as a very poor trade. Next up, we have trade number 5. And essentially we had the reversal candle. So if I just move this out the way, we had the push up with the white candle, and then the blue candle broke lower than the white candle, indicating that the market might be reversing. And again, of course, it is within the M15 POI. It's a very deep mitigation. It would have been a little bit nerve-wracking taking this trade, knowing that you've just taken 2 losses in a row, 1 viable trade, 1 probable human error trade, and then realistically the trade that you need to get into. I'm going to dispel a myth right now. A lot of people say I'm only going to take 2 trades on 1 placement. And if I get it wrong 2 in a row, then I'm going to step out of the market. That's great if you're a rookie trader, but in reality, the market doesn't care. You need to take every trade which fits your plan. So if I hadn't have taken this trade, I would have missed out on a 9.37R trade in total. So the first TP was the nearest swing. Obviously, these nearest swings are moving as the market moves, so you need to be paying attention to that. So let's just play it out. So this is how it looks after playing out. And there are possibly a few other places where you could scale into the position if you were feeling brave enough. I tend to do it quite often. Sometimes I win, sometimes I lose. But generally speaking, you could have improved on your position further still. No entry, TP2 was hit. So this was the M15, which I was looking at to try and take profit from and possibly reverse from, but there was no reversal candle right here. So we couldn't get into trade number 6 right here because price just passed right through. Now for trade number 6, which is this one to take place, what we've had to do is we have bossed down again on the M15. So we are again looking at the order blocks further away. There was initially this one, which I've just noticed, and then there was this one as well. So there may have been one which we just missed out on. Again, bit of human error, may have missed a trade right there myself. M1 dropped down to this. What did we get? We had a bit of an interesting scenario. It's the mitigation of the M15, which is great, but we've had equal highs right here. So with the equal highs, you shouldn't be moving your TP1 to here if you manage to get into the trade so early, such as with this one, okay? Because it's just an equal high. It's a swing, but it's only an internal swing. So really you want to try and go for the swing beyond that, which would be here. So TP1 would be at 4.5 right there, and TP2 is looking for the next M15, which would be all the way down here. And the result would be an 11R if you can get a TP2. So let's just see how it played out. TP1 clearly has been hit. Again, it's a perfect engulfing candle. And as it transpires, I just hadn't dragged that down. So it would have taken profit, which is superb. Now for trade number 7, which is this one coming up, we have had boss on the M15. So M15 has continued to boss its way down, which means we can now start looking at this previous order block, which we weren't considering for a counter trend one, as we hadn't had any breaks of structure. So if we drop down to the M1, we can start to identify where we looked to get involved with. I'd got involved on this one on the second candle. If you look left, it was in an area of supply coming into the market, so it kind of made sense that we'd want to be pressing away. And the first take profit is going to be the nearest swing on the M1. So let's play it out. TP1 would have been hit, and then it would have gone to the stop loss. So you'd have at least banked a little bit or got out for a very, very small loss. Trade number 8 coming up as well. Because we haven't reached our next M15 POI, which is down even further, we are still looking at the same point of interest. And it can happen. You can literally mitigate it a little bit, come back in for a retest. And this will happen every so often as well. So where did we get involved? The first rejection blue candle, again pressing below that white candle. TP1 is the nearest swing on the M1. TP2 is down, in this case, with boss, because the next M15 was literally miles away, and sometimes you just have to go with the market structure, and TP2 would have been hit. So pressing on, we again had another break of structure on the M15, which came in here, which means we revert back to the nearest order block, which is unmitigated, which is this one. Drop down to the M1, get involved on the first blue candle. We have TP1 literally just really nearby, and TP2 again absolutely miles away, and we have to come all the way back to probably a week or two before to try and get the next unmitigated M15. And that looks rather sizable at 13.87%. So let's just click on forward on the M15 quite quickly. and it came out to stop us out after hitting only TP1. Then we found ourselves stuck in a fat range for the next day or so. So there was literally nothing to do apart from sit on our hands and wait for us to break out of this area. Then the next trade came nearly a day later, when we finally had chock confirmed in the opposite direction with a series of body breaks. The next M15, which we had as an unmitigated zone, was up here, and we dropped down to the M1 after we've got the break on the M15, and we tried to get involved on a reversal candle. Again, really good signs of progress here. This is the M15, pressing down, we're getting the wicks, then we get the rejection candle on the white candle and we push up. So TP1 would be up here, and then TP2 would be the next zone. And let's see what happened. Stop out. And then again, there's another trade that you could have taken, which I don't think I recorded on the spreadsheet, but this is an instance where you may want to take the trade. It's swept the M15 area, and you've got involved not just on the first candle, but you're waiting for a second candle for confirmation. You get involved, the stop loss would be slightly bigger, covering the area, and you'd set your TP1 just here, and then TP2 at the next M15. And that one would have worked out, but the result was not recorded. So hopefully that makes a lot more sense to you. I'm just gonna run a bit where we reveal a winner from the previous video, similar to this. Then I'm gonna announce the next competition for you guys. So for this part of the video, we're going to spin the roulette wheel of names of those of you who took part in the challenge I recently set out in a video, where these lucky participants took 10 trades using the simplified version of the FTR trading strategy, which I am showing you today. And I'm pleased to say that every single one of them came out with a shockingly good result, and not a single one of them got a negative balance at the end of it. So let's spin the wheel. Congratulations to the winner of the roulette wheel. And in second, if your name is popping on the screen right now, reach out on Instagram. Your results were phenomenal. You're going to get a free slot as well. And now the announcement of the next competition, we're going to do the same thing again, but the deadline is going to be the 1st of August 2024. Give me your 10 trades, show me the results, and you will get a free slot in FTR for the next month. Now, for those of you who have braved it to the end, here is your reward. Something that I didn't show you was sliding across on here. What you can do to improve any strategy, and I see this all over YouTube all the time, a lot of gurus talking about these shit strategies that they've just found on the internet through people like me, but they do not improve on their strategies. They don't measure the core components, which is the drawdown which you get on a position. Now, for me to go into this, I'm literally just going to demonstrate what this is. Okay, so the position previously was something like this, okay? That was the position, and all what you have to do is literally measure back to where the furthest point of drawdown was on that position. In this example, it's 0.1. I'm gonna find another one. This trade right here, this was the position. The drawdown on this position, again, 0.1. And this was the first epic trade, and the drawdown, 0.1. Now the drawdown, what I mean is literally you get into the position there or thereabouts. You've got about a second to place your order. So you'll have preferably 2 monitors. I've got one monitor here, one monitor which I'm looking at, and one of them has my C trader for market entry, and my finger is hovering over buy or sell. So as soon as the market closes, and I can see it on TradingView close, bang, I'm in the market. Split second. And sometimes that is going to be 0.1 or 0.2 pips. So going back to the spreadsheet, drawdown pips is different from required stop loss, okay? So stop loss is where you want to put it to be ultra safe, but the drawdown pips is really all what is required for these positions. Now, you don't know what these are going to be ahead of time, okay? So just using this as a scenario, of course, you can't predict with these trades, but we can get an average. So with this, the difference on there was 1.4 pips that we could have saved. With that one, it's 0.8, 0.4, 1.4. It doesn't sound like very much, okay? That one is 2.2, but it makes a difference when you add 0.2 just for that margin of error, okay? It's the slowness, it's the connecting of the broker, it's you clicking the button, it's you possibly hesitating, but you shouldn't do. And then the figures go crazy. Now, before we go any further, I don't want you to get too excited by these figures. These are the maximum that you could get if you could predict the market, which you can't, okay? So unless you have this crystal ball, you're not going to get these figures, but these are the maximums that you can get. So you've got the adjusted growth has increased to 86.5, the TP1 78, and the TP2 91. Now we'd be lucky if we can get half of that. So the adjustments which we've made just here, the way to be able to do this calculation, which is what I did for the London breakout to transform it into how we trade now at FTR, is you get this figure, and you can't see it because my head's in the way, but the average of this is 0.68, which means that it's going to be 0.7 pips. So instead of you having a stop loss moving forwards of a variable figure, it will make your life a lot easier when you nominate a value to a stop loss, like what I do for a single pip. With a new value of 0.7, I can attribute my 1 or 2% of my account size to that position size. Now, these are the figures that you get once you've done that. So you're now going at 0.7, your new stop loss is right there. The difference on the original, okay, just to explain this bit to you, the difference on the original is 0.8 saving there, 1 pip saving there, 0.2, 0.1, 0. Apart from this one, which is plus 0.1, which means that this one has turned from a win into a loss. So bear in mind, if you do this and you reduce what the stop loss is going to be, and price comes back in drawdown, it's going to take you out, but you just managed to absorb it. Now we've essentially just adjusted the growth when you're splitting your positions. We've massively increased TP1 and we've slightly increased, I think, TP2. So I'm just going to go back and check that. So we had 27.5, 20.5, 31.5. We've now got 34, 31.5 and 34, which is pretty solid. Now, even though that's only a growth of say 20% on those positions, apart from this one, which is a growth of 50% on the position, that is going to make a staggering difference in your trade account over the period of even a month doing this. Now, it's doing those sorts of calculations which would separate you from the rest of the crowd, and you need to do this on a fairly regular basis. You don't have to do it every day. Make sure that you're using the optimal stop loss, okay? And that is what's going to make you rich and successful. I hope that's been helpful. Good luck. Subscribe if you haven't already, and join us at FTR because this is how we trade.